Okay, so good morning, everyone. Welcome to the Monday morning webinar. So I'll start off with Hyphens Pharma non-rated report followed by UOB. So for Hyphens Pharma, it's actually a non-rated report that we feel that is interesting to update you guys on this particular company. So valuations of Hyphens Pharma right now is around 10.2 times price to earnings, 1.5 times price to book, and dividend yield is around 2.8%. So for FY18, you can see the revenue breakdown by businesses. It's mainly driven by specialty pharma principles, and they mainly have three revenue segments: specialty pharma, proprietary brands, and medical hypermart. So what they are, I'll explain later on. So first is the specialty pharma, which is the largest revenue generator. So this is 57% of FY18's total revenue. And you can see from the picture here, these are the most popular specialty pharma products that they have. So how it goes around for Hyphens when they the business model for specialty pharma is firstly they identify new drugs. So the business development team will search for new drugs to license through conferences, researchers, and talk to doctor about the latest drugs and discoveries. So after they identified the drugs, they will sign the contract for the drug. And the contract that they go for is usually exclusive for around 3 to 5 years contractual period from the date of the launch of the drugs. And thirdly, when they register the drugs after signing the contract, it takes 2 to 3 years for drugs to be registered. And medical device is around 6 months, and cosmetic is the shortest, around 3 months. So after they register the drugs, they have a pre-launch marketing where they engage doctors to promote the drug launches and also the related treatments to the drugs. And then they get the drugs listed in hospitals through doctors. So once you get drugs listed in the hospital's drug list, the amount of drugs and pre-orders will actually shoot up due to the amount of drug use in hospitals is higher than in clinics. And then the ramp-up period for new drugs usually take a few years, and it could be faster than a few years depending on how popular the particular drug is and how widely used it is. So if you were to take into account from the first step to the fifth step, you can sort of estimate that each drug that Hyphens Pharma identify for the specialty pharma will take at least 6 years to actually ramp up in revenue generating growth to actually have significant contribution to the top line and bottom line. And then the second one is a proprietary brand. So as you can see here, maybe you have seen some of the products being sold at Guardian and Watsons. There's a Ceradan brand and Ocean Health supplements. So how it goes is that Hyphens first develops and they own the entire product formulation, the trademark, and the right to sell it anywhere in the world. And then they engage and employ manufacturers to produce the product. And the contract manufacturers, these products will bear the Hyphens trademark under the Ceradan, TDF, and Ocean Health brand. So revenue from this segment accounted for around 11% of total revenue. And this segment is have a higher margin than the next one, which is medical hypermart. So what medical hypermart is that they are a wholesaler of pharmaceutical products and medical supplies through the online platform. So they cater largely to private clinics, GPs, and pharmacies who want to procure the medical supplies and drugs online. So they have more than 3,000 customers currently and also 4,000 items listed on its online inventory. So it also has a B2B e-commerce platform as well. And this platform is a 24 hours service platform. And it is currently the only medical hypermart in Singapore. And other than selling drugs online, it also offers CME points to doctors. So doctors in Singapore have to meet a certain CME hours as part of their practicing requirements to continue practicing in Singapore. So this also provides additional stickiness for doctors to continue using this platform to procure drugs as well as complete their practicing requirements. So revenue from this segment accounted for 32% of total revenue in FY18. So for Hyphens Pharma, the largest cost generating component for them is marketing and distribution. As you can see from the chart here, is 64% of total OPEX. So this is because their ability to scale its business is very contingent on its ability to grow internationally and increase awareness of its drugs. So marketing and distribution is very important for them to continue scaling its business. And margin-wise, specialty pharma and prop brands, so prop brands are your TDF, Ceradan, Ocean Health, these products have higher margins than the medical hypermart. And dividend-wise, they do not have a fixed dividend policy, but the board has already put forth its intention to distribute at least 30% of its net profit attributable to shareholders for 2018 and 2019. And industry-wise, top-down, Hyphens feels that there are strong economic growth in ASEAN countries, as well as the increasing affluence of the population in ASEAN countries will increase healthcare expenditure, and they will benefit from this trend. And also increase life expectancy as well, and also increasing problems of skin diseases in urbanizations and countries will also benefit certain products as well as TDF. So our investment highlights is that firstly, specialty pharmaceuticals has very high loyalty and stickiness amongst doctors. So what I mean is that doctors are usually quite prudent and they prefer to use drugs that are already proven to be effective for their patients. And they require extensive convincing through medical trials, scientific evidence, as well as past experience on using a particular drug to make a switch to a new drug. So once they switch to a new type of drugs, doctors usually they will gain confidence gradually, and they will stay with a particular drug brand, which they will prescribe continuously. And the second investment highlight is that high barriers to entry for the prop brands usually equals higher margins as well as lower price sensitivity. So for Hyphens TDF as well as certain products, they usually have a premium branding of these proprietary products, and the brand reputation as well as product quality differentiation from generic brands such as Cetaphil and Physiogel will equal premium pricing for Ceradan and as well as better margins as well. So this applies to Ceradan and the TDF brand. And in addition to the generic Ceradan and TDF brand, they're also coming out with a more premium line for Ceradan and TDF, which is only accessible by doctor prescription. And lastly, growing ASEAN network, they will benefit in tandem with a strong economic growth in the region. So as you can see from the first chart up here, revenue by geography, majority of the revenue is contributed by Vietnam and Singapore, with Vietnam growing very fast. And you can see that Vietnam's GDP is shooting up over the past 20 years, and it continues to have this strong growth. So that's it for Hyphens Pharma. It's just a non-rated report to keep you updated on our company. And moving on into UOB's results last week. So for UOB, this time around is the third quarter results, and the positive this time around is that the loan growth remained rather strong at 8%. So despite this strong growth this quarter, the management expects growth to slow from current levels to around mid-single digit for the next year, FY20, due to global headwinds and dampening business sentiments. So we amended our forecast and lowered our loans growth guidance for FY20 to around 5.3%. So this time around, loans growth is rather broad-based, and despite housing growth contracting for the past 2 quarters, the market share of the housing loans remains stable. So because this is an industry-wide contraction in mortgage loans, but UOB's market share still remains stable. And the second positive is the fees income. It surged 14%, and this similarly is due to wealth management, credit card and loans related fees. They're doing very well. And AUM rose 10%, reaching 122 billion this quarter. So this is mainly due to rising affluence, and 60% is from overseas customers. So for UOB, the differentiating factor for their AUM is that it's a slow and steady rise because they're targeting the mass affluent, not the high net worth. So this proves to be quite defensive in today's volatile environment. So the negative this time around, in line with falling interest rate, is that the net interest margin fell 4 bps year on year and quarter. So it's at 1.77% as of Q19. And they guided FY20 net interest margin to contract around 5 to 10 bps, which is rather substantial. And their internal projection for FY20 SIBOR and SOR is around 30 to 50 basis points contraction. So the impact of rate cuts is quite serious on the net interest margins, but they put forth that they would also do an internal adjustment to its funding cost as well to match the pricing changes charged on the loans. So because of their amendments and guidance, we lower our forecast for FY20 net interest margins by 4 basis points to 1.74. And the other allowance, the other negative thing is the allowance this quarter. So allowances rose by 53%, and this is mainly to provide for impaired assets. So there was no particular industry that showed that has a larger proportion for this particular impaired assets allowance. And at 145 million, it is not as high as what we saw during the oil and gas crisis of around 400 million. So at this level, NPL ratio is still rather healthy at 1.5%. Third quarter last year was 1.6. So moving forward, UOB expects a slight increase in expected credit loss in FY20. And this is not because of any specific provision or impaired assets, but because, as you all know, the banks will adjust their ECL model in line with the macro environment. So if the macro environment were to weaken, they would have to provide for general provisions in the ECL model, and this will translate into uptick in GPs, and then allowances will increase slightly as well. So FY20's credit cost is not expected to exceed 25 basis points. And to put things into comparison, FY19's credit cost is around 20 to 25, and FY20's worst case scenario is 25 basis points. Yep, so that's it. And we maintain accumulate for UOB, target price $27.80. Next, I'll pass on to Natalie for CapitaLand Mall Trust.
Hi, okay, so today I'll be talking about CapitaLand Mall Trust 3Q results. So CMT's gross revenue was up by about 18% quarter on quarter, but this was mainly or totally due to the contributions from the consolidation of Westgate upon acquisition of the remaining 70% stake, as well as the full quarter contributions from Funan. Yeah, and this was offset by lower contributions from Lot 1 due to ongoing AEIs. On the positive side, the quarter CMT recorded their third quarter of positive rental reversions, ranging from 0.4% to 3.4% for all malls except for Raffles City, Clarke Quay, and Bedok Mall. The portfolio occupancy also increased 60 basis points quarter on quarter to 98.9%. Higher occupancy was recorded at all malls except for Raffles City, which was lower by 1%, and Lot 1, which was lower by 60 basis points due to the ongoing AEIs. On the negative side, year-to-date tenant sales fell by 1.3% year-to-date. This is despite an improvement in shopper traffic. However, tenant sales for the top 5 trade categories that contributed more than 70% of gross turnover improved by 1.2% year-to-date. So on this slide, I created a summary of the operating metrics. So we can see, first of all, that there has been 3 quarters of positive rental reversions. There's a recovery of portfolio occupancies. So in Q2, the occupancy actually fell by 50 basis points. It has hence recovered, since recovered. And when we compare the tenant sales to the RSI, so basically CMT actually reports their tenant sales on a year-to-date basis. So for the 9 months ended 2019, tenant sales actually fell by 1.3%. We compare this to the RSI excluding motor vehicle sales, and the RSI has actually fallen by 1.8%. Do note that this 1.8% is actually 8 months YTD, because there's no data for the 9 months yet. So basically, their tenant sales is less pronounced than decline in tenant sales is less pronounced than the decline in RSI. And we can see from this table 2 that the RSI actually has been in negative territory since November 2018. For the outlook, retail sales still remains weak. And with that, we maintain a neutral with an unchanged target price of $2.68 for CapitaLand Mall Trust. Moving on to Centrepoint, Frasers Centrepoint Trust. So this is FCT's full year and fourth quarter results. So for the fourth quarter, gross revenue actually fell by 1.5%, but this is due to the non-cash accounting adjustments. So excluding these non-cash adjustments on a cash basis, revenue and NPI was actually up by 2.8% and 4.8% for the quarter year on year. And this is due to better occupancy as well as higher average rentals. So on the positive side, we note that FCT has positive rental reversions of 4.8% for the full year 2019. This compares to last year's rental reversions of 3.2%. Shopper traffic was up by 8.9%, while tenant sales came in flat. Actually, FCT recorded higher sales at North Point, North Wing, Changi City Point, as well as Waterway Point, and the higher tenant sales of about 2 to 6%. But this was offset by the lower tenant sales at Causeway Point due to the ongoing AEIs for the underground pedestrian link, as well as at Anchor Point due to the change of tenant. Change of anchor tenant. On the negative side, occupancy slipped by 30 basis points to 97%. This is due to the ongoing AEIs, as mentioned, at Causeway Point as well as Anchor Point. So at Anchor Point, currently the occupancy is at 79%. This is expected to improve to 94% once the new anchor tenant completes their fitting out process and starts paying rent in November. So we like FCT, and we have accumulate on FCT. One of the reasons for it is because of the high of the income that is driven by necessity spending. As you can see from figure 1, 5 out of 6 of the top trade categories contributes to gross rental income, necessity spending. We also see a lot of catalysts for FCT. First of all, they still have a ROFO pipeline from their sponsor. They have about 4 assets left to acquire. They also have, together with their sponsor, they also have increased their stake in PGIM Asia Real Estate Fund. It's a private fund that invests and holds suburban retail assets, very much like the kind of assets that are currently in FCT's portfolio. So they exhibit very similar characteristics. So the catalyst or the upside that comes from this stake in PGIM is that they can, as a private fund, PGIM does not have tax transparency, so they are actually still paying taxes of approximately 10%. So the idea is that now that FCT together with their sponsor have about almost 90% stake in PGIM, they will be able to acquire assets onto the FCT platform, and hence they will be able to immediately yield tax savings from the assets from the acquisition. Another catalyst for FCT is that 2 of their largest malls, which is Causeway Point as well as Waterway Point, they are beneficiaries of the URA's Draft Master Plan 2019. So Causeway Point, which is located at Woodlands, will benefit from Causeway Point will benefit from the repositioning of Woodlands Regional Centre as the largest economic hub, while Waterway Point will benefit from the business parks and the university infrastructure that will be built in the area. Another catalyst is that there's a huge amount of HDB units that are going to be built in the surrounding areas of Causeway Point, North Point, as well as Waterway Point. And these are the three of FCT's largest malls. So an increase in HDB, the number is approximately 67%. Okay, so we reiterate our accumulate call, and with a higher target price of $3.11, this translates to a distribution yield of 5.4% for FY20 and a total upside of 17.5%. Moving on to Paul for Sheng.
Okay, thanks, Natalie. I'll move on to Siong third quarter results. I guess the title is the formula for the record profits, basically new stores, market share, and then higher margins. Okay, I need to go on to the details. So for the third quarter results, the revenue is up 11. The positives was that revenue is up due to if you eyeball this number here, basically it's an increase in new stores. So you can see that there's a 17% rise in new store footprint. So that was the part that helped revenues. And also the other point is that in the industry as a whole grew about 1.7%. Versus Siong's growth in Singapore, because this includes China, about 10%. So Siong is growing probably 5 times faster than the whole industry in terms of supermarket sales. The other positive for the results was the GP margins still at their record levels, about 27%. And part of the reasons is that there's a higher mix of fresh products, which is your vegetables, fruits, and poultry and seafood. So these are much higher margins. And what's happening is they're basically taking share from wet markets. Anecdotally, we don't have the data yet, but you can see that there are fewer and fewer wet markets being built, and there are more hawker stalls, hawker centers, standalone hawker centers. So that means there's less supply of wet markets. The negative was sorry, not admix. Admin cost was elevated due to as you know, whenever they open new stores, they have to take on a lot of upfront fixed costs, which is headcount and rental. So it takes time as the stores mature. Then this 17% of total revenues could trend down, so there could be some margin pickup. So next time when you see sales start to taper down or stabilize, then you will see these margins, net margins start to pick up further because of the stability in admin costs. There was one small closure, but there was less than 1% sales. And then in terms of the outlook, we're still positive on the outlook. Several sources of earnings growth for them in FY20. The footprint is still growing. I think they are expanding another 6 stores. So as you know, last time was 17, so you still get another 8%. Then we still think gross margins will improve, like we mentioned, the market share. And then there are some early tentative signs when you look at the data of supermarket sales actually recovering in Singapore. The other part is that the revenue per square feet will actually improve as the stores start to mature, and operating leverage as the sales build up. So we maintain accumulate because of the good metrics, and I think there will still be another one or two more years of growth at least. Okay, I'll move on to our usual weekly update. In terms of some of the data that came out from Singapore will be minimum probably come and report later, but just in Singapore, the loans growth was stable. So it's been around these levels for the past 7 months, bank loan growth in Singapore. One interesting positive was that hotels sector is doing pretty well. The RevPAR growth, which is basically room rates adjusted for occupancy, was actually up to 18-month high. So this is probably good for all the hotels in Singapore, partly due to the stable visitor arrivals. I think most of the US data, I think most of us will know. I guess the big one was payrolls, although it was weak, it was above expectations. In terms of global macro, we do see some improvement, especially this, we'll show you a chart later, the rebound in US PMI new orders. But it's not all green light on all the indicators, because like Korean exports was still down. So there is, at least there's some stability, and the market's playing on this rebound in global growth as we head into FY20. I'll move on to the corporate update. We did attend a creative technology AGM. Most of the details, if you go to this link, is in our stocks BNB. Just look out for this Phillip on the ground. Basically, these are stocks that we don't cover, but we just give an update. So basically, as you know, last year there was a lot of hype on their new Super X5 product, which is like size of a pencil, or half the size of a pencil. Basically, what it does is that you use this and you hook it up to a headphone, and you get really very good, much better audio effect. But they are facing several challenges. I think they're facing higher duties, I think as much as 25%. So firstly, they're going to get hit by higher tariffs. Secondly, they're beginning to find it's hard to push this product because it's complicated to market. Because to get the full effect of the Super X5, you need to virtually take a photograph of your face, photograph of the 2 years, download the app to get the full impact. So this sales cycle is a bit harder than expected. And it's also expensive to apply in the sense that because this is supposed to be adaptable to all headphone sets, but to do that it's pretty costly for them to buy every single headset in the market. Okay, anyway, not clear on their strategy why they want, but they actually said that they're going to refocus on China. So in a way, it's back to the drawing board for them. Yeah. Okay, and to our tactical views, we think that the play in lower interest rates, i.e. the rally in rates, probably may fizzle out in the near term because there's less market pressure for the Fed to cut rates. I'll show you the chart later. Anyway, the expectations are for, as you know, the Fed rate now is 1.75, but expectations for end of next year, another 12-month plus, is only for two more rate cuts. So we don't think that will probably means less headwind for the REITs. And just to run through the charts, there's at least a nice rebound for the US new order index here. The Singapore hotel sector is enjoying a several-month rally here. This chart here, if you focus on the orange line here, you can see that this market is expecting another 2 rate cuts at most for FY20. So in a way, it means that there's less pressure for the Fed to actually, market pressure for the Fed to actually cut rates. There could be one more cut in December, but and probably one more next year. That's what the market is expecting. Okay, anyway, that's the last slide for me. Is that our usual update on our model portfolio. So last month, up about 4%. Most of it came from the financials, like SGX did really well, and also Singtel also did really well. So this is how we compare against the STI, about 11 percentage points outperformance. This chart is just to give you some flavor next time on some of which sectors actually perform well in the month of October. So those that you see, basically it was all about the Capital Corp rally. So you see hitting here, then you can see the Sembcorp yards all helping the whole sector outperform. Industrials also did well, but you can't really see, but some of the electronic names, the semiconductor names are like UMS and so forth, they're all up almost 30% in October alone. Okay, we'll maintain our model portfolio and we usually only change it once a quarter. Okay, I'll move on to Edmund.
Hi, so right now I'll share about the US banking sector. So firstly, we see modest net interest income growth amid the Fed rate cuts. We see a broad-based net interest margin pressure for the top 4 deposit-taking banks in US. So on average, the net interest margin was down 3 bips, while the net interest income was down 1.3% year on year. And this is mainly due to the poor performance of Wells Fargo, which its NII was down 7.3% year on year. So without excluding Wells Fargo, the net interest income was up 0.8% year on year. So the poor NII growth was mainly due to the Fed rate cuts and also because there was faster prepayments of the mortgage-backed securities, which increased the premium amortization cost. So we expect a weaker 4Q19 NII due to the slowing global macro outlook. In terms of loan growth, consumer loans continue to uphold the loans growth. So the total loan growth was 2.4% a year for the 4 US banks. And we see mixed results as Bank of America and Citigroup reported strong loan growth. Wells Fargo reported 2% year-on-year increase, and JP Morgan reported a decline. So on the whole, cards loan growth was on average 3.8% year-on-year, whereas mortgage originations was up 39% year-on-year. So going forward, we expect consumer loan growth to slow at moderate pace against the backdrop of the Fed rate cuts. And we think that the strong growth in the mortgage originations in Q3 is unlikely to be sustained because even though there is strong demand, there is a tight housing supply which constrains further mortgage sales. In terms of deposits, the average total deposit growth was strong at 4.7% year-on-year, whereas core deposits was up 3%. And this is mainly due to the growth of the non-interest bearing deposits. So what happened is that in the lower rate environment, the non-interest bearing deposits are expected to grow more as higher yielding deposits become less attractive to investors. So we also expect an overall lower deposit cost. As for the retail side, they have low deposit betas, so we do not expect any significant repricing downwards. As for the wholesale side, they have higher betas, which meant that they will be repriced downwards faster, which will result in a lower deposit cost overall for the US banks. So we maintain overweight on the US banking sector because we believe that even though NII growth will decline, it is still held up by the consumer growth and is likely to moderate, but it will not decline at a very fast pace. We also believe that the slower loan growth will be offset by the lower funding cost and also strong deposit growth. So the banks are currently trading at 11.7 times earnings. We think that there is still upside potential due to the strong deposit growth. And of course, they have a diversified nature of the bank's earnings. So this is the list of the ETFs that track the US banking sector. So next, I'm going to talk about the US weekly. So as you can see for the month return, industrials and healthcare have returned more than 6%. Financials has also rise by 5%, mainly due to the earnings results. The same goes for technology as well. But year to date, we see that financials has the highest year to date return. So this is the list of the upcoming earnings results release. So the notable ones will be Qualcomm on the 6th of November and Walt Disney on the 7th. Okay, with that, I'll pass on my time to Weiren for the technical analysis.
Thank you, Edmund. So I'll move on to Straits Time Index and then followed by Dow Jones Industrial and Transportation Index. So for Straits Time Index, price rejected strongly at the demand level based on the sharing of the 2nd of September sharing, which is around 3.1K region. So based on the chart shown, we still think that the STR may be ranging for a period of time. I would think that maybe a year or two, between 2006 to 2009, which is the same direction on the share with the sharing on 2nd September 2019. So also on the last previous sharing on September, series of prolonged flats of running flats will occur, and since price has completed the W wave of the running flats, we might see a potential upside soon. Also, current price action suggests that the potential upside is still ongoing, although today market open with some correction. But over in the midterm, we are still looking at a upside to 3002 to 3003 region, which is at the immediate supply level, which highlighted. So reason being because of the corrective upward bullish channel, seen highlighted in the light blue, it actually acts as a continuation bullish movement. And then secondly, the larger bullish panel formation suggests a midterm bull run towards 3,600. So moving on, longer term wave analysis suggests that upon reaching 3006 region, highlighted at the 88.6 Fibonacci level of 2957 and 3641. So midterm action suggests that price action will be trading within the range as I mentioned earlier, but upon reaching 3006, there will be a strong bearish downward correction to a demand level at 2006, and then therefore we predicted that 2006 will be a strong third wave of the primary wave movement. So moving on, I'll move on to Dow Jones Industrial and Transportation Index. So Dow Jones Industrial may hit 28,000 if key resistance of 27,400 is broken by this week. So however, do take note that the bullish movement recently may be a false prophecy and may be a false breakout. Reason that if we move on to the Dow Transportation Index, although for the past 3 weeks, Dow Transportation Index has been edging higher. However, it's still on has not break any new high since September 2018. And for moreover, the hanging man at the resistance zone highlighted on the light red over here is suggests that the bullish may be exhausting soon for the transportation. And if we look at the industrial, the expanding triangle has been forming well on the weekly time frame. As such, we believe that the market will continue to edge higher to 28,000 to 28,230 to 40 level, and then it reverse sharply. So do take note that should 28,000 break, then there might be a strong retest of 30,000. Move on. So lastly for the call made on October, based on the last traded price, we have a return of 20.33%. So for the one that highlighted in black are still ongoing trade, and the one that in red are stop out, and for the blue means that the target price has actually been met. So with that, I end off my presentation first. Or is there any questions so far?
There's a question on energy sector for the US stocks. Unfortunately, we do not cover the energy sector, so we won't be able to comment.
Okay, we have a question. What's the risk besides US-China trade deal you foresee in the market? Or you mean, I guess this question is, what are the other risks? I think macro-wise is, unless we get some big inflation number, then that could scare the market in terms of the Fed actually easing further. I think macro slowdown is probably well priced by the market. I think everyone knows things are slow. It's already been slow for the last 2 years. I think the only surprise, apart from the well talked about US China trade deal, is unless there's some sudden surge in inflation, and that even takes the Fed need to prematurely pause any rate hike. I think that's the only outlier I can see. Other things like Brexit and so forth, I think it's really well flagged by everyone. Yeah, thanks. I'll give us some time on answering the other questions. Yeah.
Hi, there's a question on the Nasdaq 100 and SPX 500. For the technical perspective, 8,002 is the minimum target price I was looking at, and then SPX 500 is 3,100. Should 3080 be broken? I hope that answers your question. Thank you.
Hi, there's a question on the Phillip view on semiconductor sector stocks for Singapore. So we think that the semiconductor sector is recovering as a whole. We are seeing more demand for memory, especially in NAND, that's leading the recovery. So if you look at recent results from large cap semicon in the US, they are all guiding a more positive outlook. Demands citing from 5G and IoT. So names like AEM and UMS will benefit from this cycle. Thanks.
Hi, so there's a question on what's the outlook for SGX. So for SGX, the top line growth and bottom line growth moving forward will be very contingent on how well they diversify the derivatives. So recently, I released a report on SGX on how they have diversified away from securities and into derivatives. And moving forward, they're going to diversify within derivatives itself. So derivatives currently has equities, FX, commodities such as iron ore, and other types of derivatives. So for the iron ore as well as commodities, it has risen from 0% to 14% of total volumes within 5 years. So as you can see, if they continue to diversify, derivatives volume will do well in the future. And the outlook for their bottom line and top line will be very, very contingent on how well they can continue to diversify moving forward. And as you all know that the Nifty 50 issue has been settled, so Nifty 50 volume should be more or less stable. Whereas for China A50, it will be contingent on whether Hong Kong can ramp up the volumes fast enough in the long term. So outlook for SGX is positive moving forward currently, and with volatility in the market, derivatives volume should benefit as well. All right, thank you.
Hi, there's a question regarding Mapletree Commercial Trust, MCT's preferential offering of $2.24 per new unit. Is it fair price? And given that the share price is already 236 versus the consensus target of 2.207. We do not have coverage of Mapletree Commercial Trust. I guess the reason why the consensus estimate is so low is that probably the analysts feel that that's the intrinsic price given the X price, X offering price. So as to whether or not there's any upside, cannot really comment on that. But then do note that after the preferential offering, we do expect that the share price will adjust downwards.
Hi, there's a question on about the fact that you have emailed the analysts that present on the US markets webinar, but then no reply. So regarding the points platform, if you can see on the screen, you can call this number for the customer services. Thank you. All right, if there's no more questions, we'll end the webinar for today. Thank you very much for listening.